Okay guys, what I'm going to do, I only have the one screen on me today because I'm actually doing this from my home, so I'm going to close up the chat box until I've finished the presentation, because otherwise you guys are going to see sort of like a checkered box in the bottom left hand screen, which isn't going to be very pretty. So I will do that initially, and then I will bring the chat box back afterwards to answer any questions. Does that sound like a plan? And I'll keep clicking back to and from the chat box, every couple of minutes, but I might miss some of the questions as they come in, but I'll do my best to answer them afterwards. So in today's webinar, we're going to talk about price action and the pullback. Now, price action is very, very important to us, and we don't necessarily look at it the same way as everybody else, but we'll give you a little insight into our world, and then you guys can decide whether or not it's something that you all want to use. Now, in the previous webinar, we went into and we started to talk about support and resistance and all of that good stuff. And this here is sort of like a follow-on to that, where we're talking in more depth about the way that we would enter the market when the price reaches those support and resistance levels. Okay, so first of all, the disclaimer. The content of this webinar is not for investment advice and should be used purely for educational purposes only. All of the participants are advised to seek your own counsel prior to investing or entering into any trade, because spread betting and trading carries a very high degree of risk. Okay? Excellent. Now, I recognize most of the names in here, but for those of you who don't know me, my name's Alex Ong. I run a website called Traders Corner. I run that with my brother. We've been trading the market since about 2005 now, so that's, nearly 8 years. We've co-authored many articles, we've written a couple of manuals, we present webinars, seminars, all of that kind of good stuff. And if you want to follow me, you can find me on Twitter at Alex Ong UK, although I haven't been as active there recently as I have been in the past, but we'll fix it in the new year. Okay, so things that you need to consider before you actually enter. Okay, so before we actually get to the price action, these are things that you want to just sort of look into, see what's going on, ultimately just to get a good view for the market, because what we're trying to do here is we're always trying to get involved in the higher probability setups. Now, these aren't necessarily showstoppers, okay? I want you to understand that, and you can, in fact, some of them you don't need to pay as much attention to, but it's just things that we like to pay attention to, and I'll give you an example of that when we get some live charts in a second. So the first thing you want to consider is the correlated currency pairs. Now, why do you want to look at correlated currency pairs? Well, essentially, if you're looking to get into a trade and let's say you're looking to go long euro and the pound is selling off humongously. I mean, the euro and the pound used to be more correlated than they are today, but let's just use that as an example. And so you're looking to buy the euro, but the pound is selling off, horrifically. You don't necessarily want to get into that trade, because one of those are wrong. Because when the markets are moving harmonically, ultimately they should be going in the same direction. So one of your indicators, although it's not a technical indicator as such, but one of your indicators for getting into a trade is judging the strength or the weakness of another correlated currency pair. So that way you can sort of decide which way the move's going. So, for example, it's much better to get into a move where, the dollar's getting weak across the board when you're buying the euro, rather than the euro's just getting strong against the dollar. Because if the dollar's getting weak across the board, that's more likely to have a more sustained move rather than it just being driven by the one currency pair, by the one currency. Do you see what I mean? The other thing you want to look at is momentum in the markets. We hate getting into trades if we can't see momentum. That's one of our primary indicators. If we don't see momentum, we don't get involved, because we're trend traders, and that means that we want to get into a market when there's a trend in place, when the markets are moving. If there's no momentum, that's a very good indicator that there's no trend in place. Stock market, what does this mean? Well, we look at the indices as well, and ultimately we use that a similar way to the correlated currency pair. So I know from my trading, particularly for my day trading, I trade the euro and the DAX, at the same time, and I'll look at the currency pairs, and if I'm looking to get into the euro and the DAX is moving in the opposite direction, I know that perhaps there's something that's not that's not quite right there. So I kind of prefer them to be moving in the same direction, and that gives me, you know, a higher probability trade. I find that those trades work out more than when they're fighting against each other. Because what you're trying to do with trading is you're always trying to trade in harmonic markets. You want the markets to be behaving themselves. If they're not behaving themselves, then that's the times when your patterns and your trade setups, they don't work out, because, you know, more often than not, you've tested all of your trade setups during, you know, market conditions that are favorable for your particular trading style. So if you're a trend trader, you'll only be trading during the trends. Therefore, if the markets aren't behaving themselves and they're just very, you know, range bound, you don't want to be getting involved with that, because that's not what your system is about. The other thing you want to look at is the news, or supply and demand. So ultimately, just looking at levels that are about, looking at the economic announcement. Is there any, you know, is the non-farms due to come out? Are the interest rate decisions meant to be coming out? Are there any significant announcements that are due to come out at that particular point in time? You need to take a look into that, because particularly on the shorter term side, not as much on the long term side, but on the short term side, you know, if you take a trade 1 minute before a news announcement, you're just taking a punt. You're buying a lottery ticket. That's not a real trade. And finally, the last thing you want to consider are other levels in the way of your trade, because you don't want to be getting into a trade that's trading directly into a resistance level, directly into support. It doesn't make any sense. It's not high probability. Now, yes, that means that you're going to leave some on the table. 100%, you're going to leave some great trades on the table that would have made you lots of money. But you've then got to think about the ones where it saves you money. So you can't just look at those trades where you didn't get into it and it would have made you money. You've got to think about those trades which you got into, which you didn't get into, and the market immediately reversed, and you saved yourself some money by not getting into that trade. Okay? For me, for my personal trading personality, I like to have a higher strike rate. I'm not one of these people that can sit there with a 30%, 20-30% strike rate and be happy with that. I personally need to be getting it right over 50% of the time and closer to 60-70% of the time, because that makes me feel happier and all warm and fuzzy inside as a trader. But that's just my personality. And for that reason, I'm not willing to get into those trades where it's lower probability. Does that make sense? Just looking at the chat here, pullback trading presumes trend trading. Yes, exactly. We're looking at trend trading. Okay, so the entry techniques that we use: ABC reversals, candlestick patterns, and counter trend line breaks. And that's what we're going to talk about in this webinar here. In fact, I've left one out there, which is our entry for our range bar trading, but as I've mentioned to you guys before, that's something that our members get, so we can't really give that away. But these techniques I'm going to show you here, you know, they're all techniques we've used lots and lots and lots in the past, and they always worked, and they will continue to work until, you know, the end of days. So there we go. So ABC reversals, candlesticks, and counter trend lines. We're starting with the counter trend line break. Now, all of our trading pretty much used to be based on this. Okay, we'd look at candlestick reversals and ABC reversals, but we always had the counter trend line break in there in one way or another. Now, ultimately, the counter trend line break is you're looking for a trend to be in place. Then you look for the pullback. Once you get the pullback, you're looking to put your trend line across the top or the bottom of the pullback. Okay, so you're ultimately putting a trend line in there containing the pullback. Now, I'll show you what this looks like in charts in a second, but just keep that in mind for the moment. Now, this can be used as an extra confirmation with other entry techniques. So, as I said to you just now, we may use it with the candlestick patterns or with the ABC reversals, but ultimately we always have it on our chart there in one way or another. But equally, it can be used as a standalone entry technique. Okay, there's nothing wrong with using it in isolation. So what does that look like? Let me go to this and I'll go back to that trade just now. Ultimately, what we're looking at is the market to be trending in one direction. Okay, moving up like this. Once it's moving up, what you're looking to do is get your trend line across the top of the candles. Okay, so you're basically containing the price action of the pullback. Your indication to get in is the first time price breaches that trend line. Now, why are you looking to get in there? because this is the first time that price has actually confirmed for you that it's actually doing something different to what it's been doing during the whole pullback. During the whole pullback, it's been contained underneath that particular trend line. The first time price starts to try and break outside of it, that's something different. It's not a perfect science, but it's an indication that the trend could start to take hold again, and that is when you would get in. Okay? So just going back to the previous slide, you enter on the break of the counter trend line. You place your stop behind the most recent swing, and it's nice to see another pattern. All right, so going back to this here, you're in on a break of this trend line here. That's where you're entering. Your stop goes below this swing point here. Why does it go below there? Because we define a trend as being either a series of higher highs and higher lows, or a series of lower highs and lower lows, right? And ultimately, in an uptrend, for us, it's the lows that are more important. Because in an uptrend, the lows are what's keeping it in place. In a downtrend, it's the highs that are more important. To us, anyway. So what we think is that ultimately, if we get into a trade where the market has made a high, it's come down, it's made a low, it's then gone off to make another high over here. If it then starts to break down, and if it starts to break below this candle here, then technically speaking, once the price breaks below that candle, this candle here, once it breaks below there, we've actually technically got a downtrend on our hand. And one of the things that we don't want to be is a buyer in a downtrend. Okay, it doesn't make any sense to us. So that's our first sign that we could be on the wrong side of the trade. And that's why we place our stop behind that particular point there. So you're waiting for a trending market. Once you get the trending market, you draw a trend line to contain the price action of the pullback. At the very first sign that the price starts its new leg up, i.e. it breaks the trend line, you can either wait for a close or you can wait for it to break for a couple of pips. It's completely up to you. Us personally, when we used to trade like this, we would wait for the high of the previous candle to be broken. So we wouldn't quite wait for a close, but we would wait for the high of the previous candle. So this candle here, we'd wait for that to be broken and then we would be in there. That's how we used to trade that. Does that make sense to you guys? Any questions on that? ABC reversal is what some people call 1, 2, 3 setup. Yes, exactly. Yeah. Using this current method, if the correction is expanding wedge, you will lose at least 2 trades before the trend continues. Okay. Is that a statement or is that a question? I don't trade patterns like that, to be honest with you. I'm literally trading in the direction of the trend. I don't trade wedges or triangles or anything like that as such. Does that make sense, Anna? And even if you do lose 2 trades before the trend continues, if you've got a positive risk-reward ratio, then you should be okay with that in any case. You'd come out ahead of the game. The correction could be a triangle, of course, but you don't know that it's going to be a triangle in the beginning. It just could start off as a pullback, but ultimately, you've got to, as I said, I can't comment on those patterns because personally I don't trade those patterns as such. I know they manifest themselves on my charts, but I'm not looking at it and saying I'm trading this because it's a triangle. I'm just trading the price action. Okay, so when you guys are looking at price action, one of the things you need to remember is that the price is telling you a story. Okay, so you may call it a triangle, you may call it a double top, or a double bottom, or a 1, 2, 3 reversal, but ultimately all of those patterns, they're telling you a story. Okay, and that's the important thing to remember there. So if we just quickly go back to this chart here, let's talk about the story that the price is telling us. Okay, so this chart here, the market is making higher highs and higher lows. Let's talk about this story for the moment. The market moves up, it's made a high, it comes down, makes a low, it breaks out to a new high with momentum. Fantastic, that's what we want to see. The market then comes back and it looks a lot like this setup over here. So at this point in time, the market is telling us that it's likely to continue going up. Why? Because we're on a previous level of support, which becomes a previous level of resistance, which becomes support. We've got to pull back to that level there. The market then starts to make moves to the upside. So at that point in time, the story is the trend is up, the markets are going up, you need to be a buyer. However, when the market starts to stall out at C there, and it starts to roll over, and it starts to come below this point here, when it breaks B, what the markets are telling us is that the buyers were in control here. They were able to defend this level at B here. At B, the buyers were able to defend that successfully. However, the buyers didn't manage to get as far up as they did on the previous way up. Okay, so over here, the buyers were more than in control. With this here, with the market only moving up to C, what the market's actually telling us is that there aren't as many buyers involved in this move here as there were over there. And if there aren't as many buyers involved, it doesn't necessarily mean that there aren't as many that there are more sellers involved, sorry, but it does mean that the ratios have skewed slightly. So with this previous move over here, there were way more buyers than sellers. With this move here, even if the buyers haven't become sellers, if the buyers aren't buying anymore, then by definition, you're going to end up having more sellers than you do buyers. And if you've got more sellers in the market, then the market's going to go down. Does that make sense to you guys? Do you kind of see what I'm getting at there? Okay, wonderful. So, reversal patterns, ABC reversals. ABC reversal patterns are important ways of identifying the end of the pullback and the resumption of the longer term trend. We typically don't try to call tops and bottoms in terms of calling the top of a bottom of a big trend. I'm not trying to do that at all. All I'm trying to do is determine when the counter trend, when the pullback is over and when the real trend is about to continue. That's what I'm trying to do with my trading and trading these reversals. Okay, so let's not get it confused with trying to pick a top or a bottom there. We're not doing that. All right, so they're going to let us know when the resumption of the trend continues. Common reversal patterns include head and shoulders, double bottoms, ABC reversals. Ultimately, head and shoulders, double bottom are all versions of an ABC or a 1, 2, 3 reversal. Okay, the wider the base, the higher into space is the saying, or the wider the top, the faster the drop. So ultimately, what we're saying there is that the longer it takes for the 1, 2, 3 reversal to manifest itself, to create itself, the bigger the move you can expect. Okay, because you often get periods of low volatility leading to periods of high volatility. Okay, so the patterns themselves, you going for this. Now, looking at this ABC reversal, imagine that we've got a massive downtrend coming on over here. Okay, because we're looking to look at the end of a pullback. All right, so we've got a big downtrend coming here. This is a little bit of a pullback here on one of the shorter term time frames. The market comes up to a previous level of support, which is to become resistance. It hits that resistance at point A, comes down to point B, threatens to go back up, doesn't manage to get above point A, turns over, rolls over at point C. You are in there at the confirmed lower low. Your entry is on the break of B there. You either place your stop behind C if you're aggressive, or if you're a little bit more conservative, you want to give it a bit more room to run, you place your stop above A over there. Does that make sense to you all? So this is what it looks like. Leaning M on the top side, leaning W on the bottom. Okay, so you've got a downtrend here, down, 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 pullback, hits a previous level of support, becomes resistance. A comes down to B, tries to make another high, tries to continue going with the pullback, doesn't manage it. So all of the sellers that were in control all the way down here are now starting to get involved again. Now they're saying, you know what, we made a lot of money on the way down here. The buyers have had their day in the sun. We've sold it down. The buyers are coming back in. We're going to get back involved now. Sell it through there. As soon as it hits B, bang, you're in, you enter, and you have your stop above C, or you have it above A. Reverse is true in an uptrend. So you've got the uptrend coming all the way up here. The market comes back. Previous level of resistance becomes support at A here. The market then makes its first attempt to start going in the direction of the trend. Fails. Market comes back down. The buyers get back involved again now. There aren't as many sellers here. They push it through. B, that's your first indication that the trend is going to continue. You are in there. You have your stop below C or your stop below A. Okay, and it's amazing how many times this setup actually pays you. If you want a picture perfect example of one of these of this trade in action, and we were talking about it all of it wasn't this year actually, it was all of last year. But look at the dollar franc on a daily chart. Okay, look at the dollar franc on a daily chart from 2011, and this is something we were talking about with our members all through the year. Every time we got a sell to the downside, the market started to pull back. We said, okay, excellent. When it starts to pull back now, we need to be in there, look for a 1, 2, 3 reversal or a trend line break, and we're looking to get in the direction of the trend. Okay, so you guys go and take a look at that chart there, the dollar franc daily chart for 2011. And that is picture perfect. If you guys can wait for those setups, you will make money. But you have to be disciplined. You have to be patient. But if you can be disciplined and patient, you will make money. Take a picture, take a screenshot of that chart and post it on your trading station next to you. And just wait for those setups. If you don't get those setups, don't take the trade. If you can be disciplined enough to do that, you will make money. If you ask some of our most successful members, in fact, we had a webinar this week, and one of our members was saying to us that one of the biggest turning points for him was when he started to leave trades on the table, when he started not to take trades. That's when he started to become super successful and super profitable. Okay, so that should tell you something about it. Discipline is the key here. It's not about the quantity of trades, it's about the quality of trades. Okay? The target there isn't any fixed target, Anil. I mean, you can either go with a fixed target or like a 1-to-1, 2-to-1, or you can go for the next resistance point. Yes, the franc, CHF. So USD, CHF. Okay, now we'll talk about candlestick reversals. Now, I'm going to be upfront with you guys and say that we personally don't and didn't ever really use candlestick reversals ourselves. I'm not saying that they don't work. It's just saying it's not something that we use. We prefer to use the price action reversals rather than the candlestick reversals. It's just something that we were more comfortable with. Okay, but in any case, candlestick reversals, you're looking for reversals around predefined levels of support and resistance, because you want the market to say to you, you want the market to indicate to you that it's ready to go off in a different direction. Okay, you want the market to indicate to you that it's paying attention to a support and resistance level. You're not looking to take a candlestick reversal in the middle of nowhere or in the middle of a range. That does not make any sense whatsoever. And if you guys have read any of Steve Neeson's books or watched some of his videos, that's one of his biggest things that he says, that the candlestick reversals, they're very good, but you need to use them in the right context. Therefore, you need to use them in and around levels where you're expecting that sort of a price action to occur, and you want it to happen, after a trend. You're reversing a trend. So if there's no trend in place, what are you reversing? Then a candlestick is not telling you anything if it's not, succeeding a trend. So you're looking for reversals around predefined support and resistance level. Entries on the candle after the reversal candle on the break of the candle extreme, and I'll show you what I mean by that. It's a little bit more aggressive. Okay, so oftentimes you wouldn't, if you were to enter on the candlestick reversal, you wouldn't in parallel see the 1, 2, 3 reversal on another chart. So you're getting in a little bit earlier to the party. And generally this should be done on longer term time frames. And that's just, you can use it on shorter term time frames, but they're more aggressive entries. But in my personal opinion, candlestick reversals are more effective when you use it on something like the daily or something like that. If you start using it on like a 15-minute or 5-minute, yes, it can be successful, but just my personal opinion is I prefer using them on the daily. Now, I don't really care what the candlesticks are called, to be honest with you. Obviously, we have the names here, but in my personal opinion, I don't care what they're called. I care about what they're telling me. So let's go through each of these. If you see a shooting star or this kind of a candle at the top of an uptrend, what is it telling you? Look at this candle here. At one point in time, okay, this candle started it over here. So it started around the middle. At one point in time, this candle was a huge bullish candle, right? So this would have been all green all the way to the top here. That's a very, very bullish sign. However, by the end of the candle, the sellers have managed to get involved and they've managed to push it all the way down to the bottom of the candle. And it's closed around the bottom of the candle. So what does that tell you? Price action wise, what that tells us is that the very next move, the next candle, is likely to continue this trend here because it took a lot of effort. At one point in time, the buyers were more than in control there. Then suddenly the sellers got involved and they sold it all the way to the bottom of the candle. So if on the next candle, the price breaks the extreme, okay, so it breaks below the low of this candle here, then that's a very good indication that you're going to get at least some movement to the downside. Conversely, with the hammer bottom, so you're hammering out a bottom here, at one point in time, this candle was wildly bearish. It was very, very, very negative. But by the end of the candle, the markets, the buyers managed to get involved there, and they managed to push it all the way to the top of the candle and through the open of the candle, and it closed at the highs there. So again, if the market then gets involved and it continues to rally on the next candle there, that's an indication that you've got all of this buying support over here. Okay, and this is the way that you need to think about your trading. All of these buyers here pushed it to the top there. The likelihood is they're going to continue buying into the next candle, and that's going to push it up some as more. You've then got the doji, and the doji is an indecision candle. And the reason for that is that it's not going anywhere. Okay, so at one point in time, the market was negative, and at another point in time, the market was positive. But by the end of the day, the market ended at neutral. It ended up where it started. And what that tells us is that neither the buyers nor the sellers were involved for this particular candle here. Both of them had a go, but none of them actually succeeded. And now candle and the bearish engulfing and the bullish engulfing candle. The bearish engulfing candle you find at the top of an upwards movement. And what this is telling you here, okay, so if we take a look at these candles, this candle opened up here, pushed up. It's an okay candle. It's quite positive. But if we look at this next candle here, the wicks of this completely engulfed the whole of this previous candle here. But more importantly, this candle opened up positive, okay? It probably pushed up to the top of this candle. It came back down, it sold all the way down, and then closed around the low here for a negative close. And you've got a massive big body candle there. That shows you that the sellers are more than in control here. So the markets, and you want to see this at the top of an upwards movement. So the market's been moving upwards. It comes to a resistance level. You get that bullish candle there. Immediately after that bullish candle, the bears get involved. They say, no way. Okay, the sellers are in control here. We're going to sell it back down. You get a big candle like that there, and you're looking to jump in on the bandwagon. You're looking to sell it there as well. By the same token, over here, the bears were in control, so you've got a massive downwards movement there. Then the bulls get involved. They completely engulf this previous price action here. So it's basically saying, you know what, that price action meant nothing. All of the effort that you put in here to get the market to close down towards the lows there means nothing because the buyers are now in control. And look at how far we pushed it in comparison to how far you pushed it when you were selling it. Does that make sense? Okay, do you guys understand that? Yeah? So would you say that there'd be... We'll take a look at some charts in a second. Okay, if we have some time. But that's ultimately what you're looking for. You're looking for the price action to tell you a story. It's not just about the fact that the candle is a bullish engulfing or a bearish engulfing candle or anything like that. It's about what the price is actually doing. Okay. So come to our final slide here, and this is about the pullbacks. And I'm actually going to jump over to a chart to show you guys the pullback, because ultimately this was a big aha moment for our members. This was when we started to show them our new system, we started to talk about the pullback and how important it is to have a nice harmonic pullback. And this kind of really changed some people's trading for the better. Now the key is in the pullback. You're much more likely to get a good trade after an orderly pullback than you are with a messy volatile one. And I'll show you examples in a second. But by the same token, orderly pullbacks demonstrate a clear distinction between who is in control. Okay, it shows you that, if the buyers are in control and you've got a nice pullback to the downside, we're not necessarily saying that the sellers are in control, but all you're seeing there is that the buyers aren't looking to get in control of that market. They aren't trying to push the markets higher. They're probably taking profit, which means that the next time that the buyers get involved, the sellers probably aren't going to want to get in the way in the first instance. And all of our better trades occur as a result of a good pullback. All right, so with that in mind, let me pull up a chart now and show you exactly what I mean. And we'll go to yesterday's trading for this. Okay, you recognize the difference between a pullback and a trend reversal by the fact that the trend reversal is going to be, you're going to have a change to the dynamics of the market. So a pullback is just going to be, one pullback. A trend reversal is going to be a series of pullbacks in the opposite direction of the trend, creating, so if you're in a downtrend, you'll start to see higher highs and higher lows. And if you're in an uptrend, the reversal will start to see lower highs and lower lows. Okay? So this is the markets that we were trading yesterday. All right. Now what I want you to see is look at these pullbacks here and look at the price action after them. So this pullback here is a very nice pullback, beautiful pullback, and look at the market. Gives you nice opportunity to make some money. Okay, look at this little pullback here, this consolidation zone. What happens? It goes nowhere. How do you make money on that? There's not really enough space to make any money there whatsoever. By contrast, then look at when the market does start to pull back nicely. Sorry, we've got somebody in here. Mod, could you mute yourself, please? Thank you. Okay, so if we take a look at this pullback here, so that is ugly price action. That's a disgrace. It's disgusting. Take a look at this over here. Look at that. Very nice pullback, and what happens after it? So the pullback precedes it, and then after that you've got a very nice sell-off to the downside. Another nice pullback here. Look at the sell-off. Now take a look at this. This is consolidation. That's not a pullback. It's ugly price action. So what happens? Nothing. You don't really go very far. A nice pullback over here. The market sells off. Okay, and this manifests itself all the way on the charts. We get a nice pullback over here. Plenty of opportunity to make some money. A nice pullback, opportunity to make some money. And let's look at an ugly pullback. Okay, look at this over here. What sort of a pullback is that? It's not really showing you anything, doesn't do anything. And where does it go? Nowhere. The market sells off. What about this? So the market tries to rally, pulls back a little bit, ugly, sells off again. Okay, then we take a look at this here. The market sells off. You've got momentum in the market. We like to see that. Nice pullback, sells off. Again, a nice pullback. The sellers were in control here. They decided to take some profit. They're not trying to get involved. The first point they really get involved, we get our signal to get in here, right over there, and the market sell off down to the pivot. Gives you plenty of opportunity to make your money. So does that make sense to you guys? Do you see how when you get nicer price action, you get more harmonic price action, the markets pay you? Okay, when you don't get the harmonic price action, when the bulls and the bears are arguing, when they're battling out, when they can't agree on the direction to go or anything like that, you don't get some of the trades work out. Yes, they do. Okay, we cannot deny that. But a lot of the time, it doesn't pay you. So why would you want to get involved in trades like that? It doesn't make any sense. Generally the bodies, DV. Generally the bodies. Which particular price action reversal are you talking about, Sylvester? Are you talking about the 1, 2, 3s? There have been a lot of previous ones. 1, 2, 3, but we've only got sort of maybe 5 minutes left. The candlestick reversals. Are you talking about candlesticks, Sylvester? Wait. This or this. Okay, let me go slowly. This, ABC reversals over here. Okay, ultimately all you're looking for is you're looking for the price to, ultimately you're looking for the price to be in a downtrend, for example, for this one at the top here. So the price is in a downtrend. It then starts to pull back. When it pulls back to a previous level of support or resistance. In fact, what I'm going to do is I'm going to bring up the dollar franc chart, okay, the one that I was telling you guys about, so that we can really see what this looks like. Now let me zoom out a bit so that I can show you picture perfect what it looks like. Okay, so it's this time period here. Okay, I was trading with our members, and if you take a look, every time the price broke through a low, so if we go here, okay, you go here, if you go here, I'll zoom in a little bit. Okay, so price breaks through a low, okay, it breaks through this previous level of support here. It comes back to that previous level of support. Support becomes resistance. If we were then to zoom in there on a 4-hour chart, for example, if I can see it, that is your 1, 2, 3 reversal. So the market's broken through that low. Fantastic move. It pulls back to that level. We're expecting the markets to turn around at that level. Okay, that's exactly what we're expecting. So we're anticipating that price turns around at this level. We're not predicting it. Okay, so just because it gets to that level, I'm not going to sell. I'm waiting for the price to tell me what it's going to do. So the price gets back to that level. It breaks through it. It comes down. It makes a low. It then comes up here. It tries to make a high, but it doesn't get above this previous high here. It's not getting above there, so that's an indication to us. If the market then starts to sell off below this level, that's now telling us that, you know what, I'm going to talk about the actual moment. As soon as the market breaks through this low here, you are in there. You're in there short. You have your stop above the high here, or you have your stop above the high there. Okay, it gets directly through that level, and you're in there short. And the same thing manifests itself again. All right, the market comes up to this level. It goes through the high of that level. It comes down. It makes a low. The market then goes up to make another high. It fails to get above this previous high here, breaks through this low, and once it breaks through that low, it messes about for a little bit, but ultimately it then goes off to test the lows of the daily candle. Does that make sense for you guys? Excellent, Sylvester. So 1, 2, 3s of the pullbacks. Yes, Boyke. So you're waiting for the pullback, and then you look for the 1, 2, 3 at the end of the pullback. Any other questions at all, guys? Now I want you guys to remember that ultimately trading is not a perfect science. Okay, so you're not going to get the textbook 1, 2, 3s. You need to train your eye to see these things. And the only way you can do that is with practice, is with screen time. It's not going to happen overnight. It's not just going to magically appear on your charts as and when you want them. You need to wait for them, you need to use your experience, and you need to learn to use the price action. The fibs, yes indeed I do. You can look at Fibonacci levels. In fact, if we go back to that again, I'm sorry I use this, but it's just perfect. If you guys can just etch this into your brains, into your memories, then you will be able to make money. And look at this for Fibonacci. In fact, let me change the color there a little bit. Previous level of support becomes resistance, 50% level of the Fibonacci. Look at that trade. Let's move that down again. What is that? 50% previous level of support becomes resistance. You can't make this stuff up, guys. This is stuff that we were talking about live when the markets were happening. You can't make it up. It's amazing. It's almost like a self-fulfilling prophecy. The targets are generally we look to take some money off when you get towards the lows there, and then look to leave some to run. We don't use fib levels for targets. I've never have, so I wouldn't be able to tell you how to use a fib level as a target annual. Exactly. Okay then, guys. Well, we're coming towards the end of our allotted time. We have about 2 minutes left. So I will wrap this up by saying thank you very much for watching it. I appreciate you all watching. I hope you all managed to find some good stuff from this. As I said to you before, it's really not a perfect science, but it definitely is a technique that can make you money. Okay, and if you look at it over the long run, if you look at this chart here, dollar franc from 2011, please study that chart, because this makes you money in the long run. Okay, so thank you very much, guys, for watching. I really appreciate it, and I will see you guys next month when we're back on FX Street again. Okay, thank you very much, Maud. Thank you, FX Street team. I hope you all have a very good end to your year. Very good Christmas. Merry Christmas, everybody. And I look forward to speaking to you all soon. Okay? Take care now. You are most welcome, Maud. It's been a pleasure. Hopefully we can do more next year. Okay, take care now and see you soon.